Hello, friends. Welcome back to Time Affairs. Today, we are diving into the legendary book One Up on Wall Street by Peter Lynch, a must-read for anyone who wants to master the art of stock investing. In this video, we'll explore all 20 chapters, breaking them down step by step. From understanding how to pick winning stocks to designing the perfect portfolio, we've got you covered. Each chapter comes with powerful insights that can transform your investment journey. So, stay tuned as we uncover the secrets of successful investing, chapter by chapter. Don't forget to like, share, and subscribe for more amazing content. Let's get started. In the first chapter of One Up on Wall Street, The Making of a Stock Picker, Peter Lynch takes us through his own journey of discovering the world of investing. He starts by telling us that becoming a great stock picker isn't about being born with some special talent. It's all about hard work, research, and learning through experience. Lynch points out that most people, especially beginners, think stock picking is something only experts can do. But that's not true. It's a skill that anyone can develop. The key, according to Lynch, is to start small and learn as you go. He emphasizes that you don't need to be a financial wizard or have a fancy degree to succeed in investing. What you need is curiosity and a willingness to dig deep into companies you're interested in. Lynch shares how he began with just a simple interest in businesses. As he looked at companies, he didn't just follow the crowd. He took time to understand the companies themselves, how they operated, what made them unique, and whether their products or services were something people really wanted. Over time, this approach allowed him to spot opportunities before others did, giving him a huge advantage in the stock market. Lynch encourages us to trust our own observations and experiences. If you're a consumer, you already have valuable insight into businesses just by using their products or services. You might not realize it, but this everyday knowledge can give you a leg up when picking stocks. The biggest takeaway from this chapter is simple. To become a successful stock picker, you don't need to be a genius. You just need to be willing to learn and observe the world around you. So, whether you're shopping, watching TV, or just chatting with friends, always be on the lookout for clues about businesses and industries that could make you money in the stock market. This is a great starting point for anyone interested in investing, because with the right mindset and a bit of effort, you can become your own stock picking expert. In the second chapter, The Wall Street Oxymorons, Peter Lynch dives into the world of professional investors and the unique challenges they face. He starts by explaining that Wall Street is full of what he calls oxymorons, things that seem contradictory but are actually true. For example, Lynch talks about how professional investors, like those working for big funds, often have to follow strict rules and guidelines. They can't just invest in whatever they think is best. They have to stick to certain strategies, like only investing in big companies or following a certain risk profile. This can sometimes hold them back from making bold, smart moves that could lead to huge profits. Now, here's where it gets interesting. Lynch points out that individual investors, like you and me, actually have a big advantage over these big money professionals. Why? Because we don't have all those rules and regulations tying us down. We have the freedom to act quickly and independently, which means we can take advantage of opportunities that others might miss. Let's say a small company starts to show big promise. While a professional investor might hesitate because of strict guidelines, an individual investor can jump in without overthinking it. This flexibility is a huge edge in the stock market. Lynch calls it the advantage of being small. He also emphasizes that individual investors don't have to be experts or have insider information to succeed. We can take our time, do our own research, and invest based on what we truly believe in, without worrying about keeping up with the market or other investors. In short, Lynch teaches us that being an individual investor isn't a disadvantage, it's an opportunity. The flexibility, speed, and freedom we have allow us to make decisions without the restrictions that professional investors face. So, instead of feeling overwhelmed by Wall Street's giants, we should embrace the fact that we can move faster and more freely in the stock market. In the third chapter, Is This Gambling or What?, Peter Lynch tackles a big misconception that many people have about investing. A lot of folks think that investing in stocks is just like gambling. You're taking a huge risk, and it's all based on luck. But Lynch is here to set the record straight. He begins by explaining that investing isn't about rolling the dice and hoping for the best. Unlike gambling, where the odds are stacked against you, investing in stocks is about making informed decisions based on research, not chance. Sure, the stock market can be volatile, meaning prices go up and down, but that doesn't mean it's a gamble. Lynch uses historical data to show us the bigger picture. He points out that over the long term, stocks have consistently outperformed bonds, which are considered one of the safest investments. While bonds may seem like a less risky option, their returns are much lower compared to stocks. And in the long run, investing in stocks has historically provided much higher returns despite the short-term ups and downs. Lynch also talks about how when you invest in stocks, you're actually investing in real companies that make products and provide services, companies that are growing and improving over time. When you gamble, you're just hoping for a lucky streak. But with investing, you're making decisions based on facts and solid research. The key message here is simple. Investing is not a game of chance. It's a smart way to grow your wealth over time, especially if you're willing to put in the effort to understand the market and the companies you're investing in. Yes, there are risks, but if you stay patient and stick to solid researched investments, you're much more likely to come out ahead than if you were just gambling on random bets. So, next time someone tells you investing is just like gambling, you can confidently say, no, it's actually a long-term strategy for building wealth. In the 4th chapter, Passing the Mirror Test, Peter Lynch gives us some really important advice before we dive into investing. It's not just about picking the right stocks. It's about making sure you're personally ready for the ups and downs of the stock market. Lynch starts by saying that before you start investing, you need to ask yourself some tough questions. He calls this the mirror test. This is where you look at yourself in the mirror and honestly assess your financial situation and personality. Are you financially stable enough to invest? Do you have enough savings to handle emergencies, or are you relying on the money you plan to invest for day-to-day expenses? If you're in debt or struggling financially, Lynch advises holding off on investing in stocks until you're in a better position. Next, Lynch focuses on risk tolerance, which is all about how comfortable you are with the idea of losing money. The stock market is full of ups and downs, and prices can swing wildly. So, before you start investing, ask yourself, how would I feel if my stocks lost value? Would I panic, or would I stay calm and stick to my strategy? If you think you might panic easily, it might be a sign that you need to develop more patience before diving in. Patience is key, and Lynch emphasizes this throughout the chapter. The stock market rewards long-term investors, and if you're not willing to wait and see your investments grow over time, you might find yourself making impulsive decisions, which can hurt your returns. Lynch also talks about the importance of discipline. Investing isn't about following trends or jumping into the next hot stock. It's about sticking to a solid plan and being disciplined enough to ride out the market's ups and downs without making rash decisions. The bottom line here is this: investing is not just a financial commitment, it's a personal one. Before you start buying stocks, you need to make sure that you're in the right financial position, that you understand the risks involved, and that you have the patience and discipline to stick with it for the long run. So, before you start investing, take a good look in the mirror and ask yourself if you're truly ready. This step is just as important as picking the right stocks. In the 5th chapter, Is This a Good Market? Please Don't Ask, Peter Lynch gives us some solid advice about one of the biggest mistakes many investors make: trying to predict the direction of the stock market. Lynch makes it clear that trying to guess whether the market is going to go up or down is not only impossible, it's a waste of time. He calls this a common mistake because, unlike picking individual stocks, predicting the market's movement is like trying to read a crystal ball. It's unreliable and usually wrong. Lynch advises against focusing on whether the market is in a bull or bear phase, whether it's rising or falling. Instead, he says, focus on what you can control: individual companies. Instead of worrying about the market's daily fluctuations, spend your time researching companies that interest you, learning about their products, their leadership, and their potential for growth. Why? Because over the long term, the success of your investments is determined by the performance of the companies you own, not the overall market. Even when the market goes down, there are always companies out there that are doing well, making money, and growing. If you invest in solid companies, they'll do well, regardless of what the market is doing. Lynch also emphasizes that it's easy to get distracted by the media and all the noise about the stock market. News about market crashes or huge swings can make you feel like you need to act fast. But he warns against reacting to headlines. Instead, stay focused on the companies you've researched and trust in their long-term potential. The key takeaway here is simple. Don't waste time trying to figure out whether the market is good or bad. Instead, focus on finding companies with strong fundamentals, good management, and growth potential. The market will do its thing, but if you focus on the right companies, your investments will pay off in the long run. So, forget about the market and start thinking like an investor, one who knows that great companies can succeed no matter what the market's doing. In Chapter 6, Stalking the 10-Bagger, Peter Lynch introduces one of his most exciting concepts, the 10-Bagger. A 10-bagger is a stock that increases in value by 10 times its original price. That means if you bought a stock for $10, it would grow to $100. Sounds amazing, right? But Lynch isn't talking about luck here. He's explaining how individual investors like you and me can find these incredible opportunities by using something we all have, our everyday experiences. Lynch starts by emphasizing that a 10-bagger doesn't have to be some mysterious, unknown stock. In fact, some of the best 10-baggers are in companies you might already know, products you already use, or services you already love. This is where your everyday life becomes a goldmine for stock-picking ideas. He encourages you to think about the companies and brands you interact with regularly. For example, maybe you notice that a small, local business has been growing steadily, or you've been using a new app that's taking off. The key here is to spot companies that have strong potential for growth and are flying under the radar of big institutional investors. Lynch also talks about the importance of doing your homework. Finding a 10-bagger isn't just about picking a random stock. It's about digging deep into the company's fundamentals, how well it's run, how it's expanding, and whether there's real potential for growth. He advises that you look for businesses that are still growing at a fast pace, even if they're not getting attention from the mainstream media. The beauty of being an individual investor is that we have an edge in spotting these opportunities early. We don't have to wait for Wall Street analysts to discover these hidden gems. We can spot them through our own personal experiences and observations. Lynch explains that finding a 10-bagger is rare, but it's not impossible. It takes a mix of research, patience, and the ability to see potential where others might not. And the best part? You don't need to be a financial genius to find these opportunities. Just use your everyday experiences, do your research, and be patient. So, if you're out and about, using new products or noticing new trends, keep your eyes open. You could be spotting the next 10-bagger right in front of you. That's how some of the most successful investors got their big wins, by looking for growth in places others overlooked. In Chapter 7, I've got it. What is it? Peter Lynch stresses one of the most important lessons for investors. Don't jump into a stock just because it seems like a good idea or because someone told you about it. Instead, take the time to do thorough research and understand exactly what you're investing in before you put your money on the line. Lynch explains that many new investors get excited when they hear about a hot stock or a trending industry. They might think, this is it. This is going to be the next big thing. But jumping in without fully understanding the company or its business can lead to big mistakes. It's easy to get caught up in the hype, but Lynch cautions against making impulsive decisions. He shares that before you invest in any company, you need to ask yourself, what does this company do? How does it make money? What's its competitive advantage? Is it growing? And if so, how fast? By understanding the fundamentals of the business, you'll have a much better idea of whether it's a solid investment or just a fleeting trend. Lynch also warns against buying stocks just because they have a catchy name or because everyone around you is talking about them. Many times, those hot stocks are overpriced or overhyped, and they might not have the solid foundation needed to grow long term. He emphasizes that smart investors are those who are willing to look deeper, those who will ask the tough questions and understand the true value of the companies they invest in. Lynch shares that even after he gets excited about a stock, he always takes the time to look at the company's financials, its management, and its future potential before pulling the trigger. Impulse buying in the stock market rarely leads to good results, and Lynch believes that doing your homework will set you apart as a successful investor. The big takeaway here? Don't invest based on trends or tips from others. Take the time to really understand what you're buying. A little research goes a long way, and it's what helps you make informed decisions that lead to long-term success in the stock market. So next time you hear about a hot new stock, take a step back, do your research, and make sure you really get it before making your move. In Chapter 8, The Perfect Stock, What a Deal, Peter Lynch shares some fascinating insights into how to spot the perfect stock. And guess what? It's not always the flashy, trendy companies you might expect. In fact, sometimes the best investment opportunities are found in companies with boring names or products that don't get much attention from investors. Lynch points out that many investors make the mistake of chasing the latest exciting trend, but often the real opportunities are hiding in plain sight. These companies might not be glamorous or have the buzz surrounding them, but they have solid, sustainable businesses that are often undervalued by the market. The reason? Simply put, lack of attention. Lynch explains that many times companies with boring products or names, like a simple old-school manufacturing company or a business that doesn't try to be trendy, get overlooked by most investors. People don't get excited about them, so the stock price stays low, even though the company is doing well and growing steadily. This creates a perfect opportunity for investors who are willing to look beyond the surface and focus on the fundamentals. For example, a company that makes something as simple as a tool or a product that's essential but not flashy could be a hidden gem. Since it doesn't have the cool factor, the stock might not get much media attention or hype. But when you take a closer look, you might find that it's a well-run business with a strong financial position and steady growth potential. Lynch stresses that the ideal investment opportunities are often found in companies that don't scream for attention. They may not be the ones making the headlines, but their steady, consistent growth can lead to great returns over time. So, when you're looking for the perfect stock, don't just chase after the trendy or flashy companies. Look for those businesses that might seem boring at first glance, but have solid foundations and a track record of steady growth. Those are often the companies that offer the best deals and long-term investment success. In short, sometimes the best investments are the ones that no one else is talking about, because while everyone's chasing the hype, you can quietly grab the steady, reliable winners. That's the key to finding a perfect stock. In Chapter 9, Stocks I'd Avoid, Peter Lynch shares some valuable advice on what to stay away from when picking stocks. While it's important to know what to look for in a good investment, it's just as crucial to recognize the red flags that signal a stock isn't worth your money. First, Lynch advises against buying into hot stocks in hot industries. When everyone is talking about a certain sector, like tech, biotech, or another trendy industry, the stock prices often become inflated, and the hype can cloud your judgment. These stocks might be way overpriced, and while they might seem like a great opportunity, the reality is that they're usually risky and might not deliver the long-term gains you expect. Next, Lynch warns about companies that have big plans but no earnings to back them up. Companies that promise huge growth but haven't yet shown they can make a profit are risky. A lot of companies have grand ideas, but without solid earnings, it's just wishful thinking. He suggests staying away from businesses that are burning through cash with no clear path to profitability. Finally, Lynch emphasizes the importance of investing in businesses that you understand and are genuinely interested in. If you don't understand how a company operates, what it does, or how it makes money, then it's probably not a good idea to invest in it. It's easy to get lured into stocks that seem exciting or complicated. But investing in something you don't understand is like taking a leap of faith without knowing where you'll land. Lynch reminds us that successful investing isn't about chasing the latest trends or taking blind risks. It's about making informed decisions, knowing what you're getting into, and understanding the company's potential for growth. So, stay away from the hype, avoid companies that are all talk and no action, and don't invest in businesses that you can't wrap your head around. The bottom line here is simple. Don't fall for the flashy stocks that everyone else is chasing. Stick to what you understand. Look for companies with solid earnings and a proven track record, and avoid risky, overhyped opportunities. This way, you'll keep your investments on the right track. In Chapter 10, Earnings, 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 Peter Lynch emphasizes one of the most important factors when picking stocks: earnings. It's simple. A company's earnings are what ultimately drive its stock price. And if you're going to make smart investment choices, you need to pay close attention to this. Lynch explains that earnings are the lifeblood of a company. They show how much money the company is actually making after all the costs are taken into account. Strong and consistent earnings are a good sign that the company is healthy and has the potential to grow. So, when you're looking at a stock, always ask yourself, is this company earning a solid profit? Is it growing year after year? Lynch advises that you don't just look at the earnings in one quarter or 1 year. What matters is the long-term trend. A company that has steadily increased its earnings over time is more likely to continue doing well in the future. It's not about flashy one-time gains or random spikes. It's about reliable, consistent performance. He also warns against getting caught up in companies that have big ideas but aren't showing any actual earnings yet. Just because a company has a cool product or an exciting future doesn't mean it's a good investment if it's not making money. Earnings are proof that the business is actually succeeding, and that's what will drive the stock price up in the long run. In short, when you're looking at potential investments, focus on earnings. Look for companies that have a proven track record of strong, consistent earnings growth. This is one of the clearest indicators that a company is on the right path and that its stock has real value. So, before you make any investment, dive into the company's earnings history. The stronger and more consistent, the better. And remember, the stock market isn't about following the latest trends. It's about finding companies that are actually making money and have a solid foundation for future growth. That's the key to successful investing. In Chapter 11, The 2-Minute Drill, Peter Lynch introduces a simple yet powerful tool to help investors quickly evaluate a company before deciding to invest. It's called the 2-Minute Drill, and it's exactly what it sounds like. Within just 2 minutes, you should be able to summarize the key points about a company's prospects and challenges. If you can't do that, then it's a sign you need to dig deeper before making any investment decisions. Lynch explains that when you're looking at a stock, you don't need to be an expert in every industry or company, but you do need to be able to explain what the company does and what its future looks like. In just 2 minutes, ask yourself a few key questions. 1. What does the company do? Is it a business you understand? Does it offer a product or service that is in demand and likely to grow? 2. What are its prospects? Does the company have a solid plan for growth? Is it expanding into new markets or launching new products? How does it compare to its competitors? 3. What are its challenges? What risks or obstacles might the company face? Is it dealing with increased competition, regulation, or other external factors that could impact its growth? By being able to answer these questions quickly, you'll have a clearer picture of whether the company is worth investing in. This quick drill helps you avoid getting lost in the details or distracted by the hype. Instead, you focus on the fundamentals, the company's actual prospects and challenges. Lynch emphasizes that this isn't about making rushed decisions, but about forcing yourself to really understand what you're investing in. If you can't explain a company's business in 2 minutes, then it's a red flag that you need to learn more before committing your money. So, before you invest in any stock, take a minute, run through the 2-minute drill, and see if you can quickly summarize the company's strengths, weaknesses, and growth potential. If you can't, it's time to dig deeper or move on to the next opportunity. This quick evaluation method keeps your decisions focused, informed, and, most importantly, smart. In Chapter 12, Getting the facts, Peter Lynch gives us a practical checklist to evaluate companies before deciding to invest. He makes it clear that you don't have to be a financial genius, but having a solid understanding of a few key financial metrics will make you a smarter investor. Let's break down the most important factors Lynch suggests you focus on. First up, the price to earnings PE ratio. The PE ratio tells you how much investors are willing to pay for each dollar of a company's earnings. A low PE might indicate that the stock is undervalued, while a high PE could mean that the stock is overpriced. But don't just look at the PE in isolation. Compare it to other companies in the same industry to get a better sense of whether it's a good deal or not. Next, Lynch highlights institutional ownership. This refers to the percentage of a company's stock owned by large institutions like mutual funds or pension funds. While it's not a deal breaker, if a company has a high level of institutional ownership, it can signal that professional investors have faith in the company. On the other hand, if the company is mostly owned by insiders or individual investors, it's worth paying extra attention to the reasons why. Balance sheets are another key factor Lynch recommends you check out. A balance sheet shows a company's assets, liabilities, and shareholders' equity. In simple terms, it tells you what the company owns and owes. Look for a healthy balance sheet with low debt and a good amount of assets. Companies with too much debt are riskier, especially in challenging economic conditions. Finally, Lynch emphasizes cash positions. A company with strong cash flow and a solid cash reserve is in a much better position to weather tough times. This means the company can continue to grow, pay dividends, and even invest in new opportunities. If a company has little cash on hand or is constantly borrowing money, it's a warning sign that they might be struggling to maintain operations. By checking these factors, PE ratio, institutional ownership, balance sheets, and cash positions, you'll have a much clearer picture of a company's financial health and potential for growth. Lynch encourages investors to keep these facts in mind before making decisions, as they'll help you avoid risky investments and identify companies that are on solid footing. So, next time you're thinking about investing, remember to get the facts first. Use Lynch's checklist, analyze the numbers, and make sure you understand the company's true financial position. This way, you'll be investing based on facts, not just hype. In Chapter 13, Some Famous Numbers, Peter Lynch dives into a few more important financial metrics that every investor should understand when evaluating a company. These numbers are essential for gauging a company's financial health and figuring out whether it's a good investment opportunity. Let's break them down. First, Lynch talks about the debt-to-equity ratio. This ratio shows how much debt a company has compared to its shareholders' equity. In simple terms, it tells you how much a company is relying on borrowed money versus its own funds to run its business. A high debt-to-equity ratio means that the company might be over-leveraged, which can be risky, especially if the economy takes a downturn. On the other hand, a low ratio means the company is less reliant on debt and might be more stable. Next, Lynch explains dividend yield, which is another key number to consider. The dividend yield tells you how much money a company pays out in dividends relative to its stock price. It's like the return you get on your investment from dividends alone. A high dividend yield can be attractive to investors looking for regular income, but Lynch warns that if it's too high, it might signal that the company is struggling to grow and is just trying to attract investors with big payouts. Always make sure the company can afford the dividend and that it's sustainable in the long term. Lynch also emphasizes that these numbers should be considered together, not in isolation. For example, if a company has a high debt-to-equity ratio but also pays a strong dividend, you need to dig deeper to understand why. It could be a good investment if the company is growing quickly and generating strong cash flow, but it might also be a sign of financial instability if it's struggling to manage its debt. So, what's the takeaway? The debt-to-equity ratio and dividend yield are just two of the key numbers that help you understand a company's financial position. Always check these ratios to get a better sense of whether a company is on solid ground or if it's facing financial challenges. By keeping track of these famous numbers, you'll be more equipped to make smart, informed investment decisions. Before you buy any stock, make sure you take a look at these critical financial metrics. They'll help you spot red flags and avoid companies that are too risky. This is how smart investors use numbers to their advantage. In Chapter 14, The 20 Most Asked Questions, Peter Lynch tackles some of the most common questions that investors often have. He offers practical, easy-to-understand advice on a range of topics, from portfolio diversification to handling market downturns. Let's take a look at some of the key takeaways. One of the most common questions Lynch addresses is about diversification. Many investors wonder how many stocks they should have in their portfolio. Lynch suggests having a diverse mix, but not going overboard. He believes you should own enough stocks to spread out your risk, but not so many that you can't keep track of them all. Around 10 to 20 stocks should be enough to give you a balanced portfolio. Diversification helps reduce risk, but remember, quality matters more than quantity. Lynch also gives advice on what to do during market downturns. It's natural to feel nervous when the market drops, but Lynch reminds us that downturns are a part of investing. The key is to stay calm and avoid making impulsive decisions. If you've done your research and invested in solid companies, there's no need to panic. Instead of selling in a panic, consider it an opportunity to buy more shares of great companies at a discount. Another big question Lynch answers is whether it's better to invest in growth stocks or value stocks. He believes there's no one-size-fits-all answer, and both types of stocks can be part of a healthy portfolio. Growth stocks are exciting because they have the potential for high returns, but they can also be riskier. On the other hand, value stocks may be undervalued and offer steady growth with less risk. Lynch encourages investors to look for companies that fit their individual goals and risk tolerance. He also shares tips on how to handle stock-picking mistakes. Everyone makes mistakes, and Lynch is no exception. He advises investors to learn from their errors, but not to dwell on them. Instead, focus on the future and look for the next great investment opportunity. Lynch answers many more questions in this chapter, offering practical advice for all levels of investors. Whether you're just starting out or have been investing for years, Lynch's advice is grounded in common sense and proven strategies. So, what can we learn from this chapter? The key is to stay calm, be thoughtful in your approach, and don't get caught up in the hype. Whether it's diversifying your portfolio, handling market dips, or learning from your mistakes, Lynch's answers remind us that successful investing is all about staying informed, making smart decisions, and keeping a long-term perspective. In Chapter 15, Stock Categories, Peter Lynch breaks down stocks into 6 different types, each with its own characteristics and investment strategies. Understanding these categories can help you make smarter decisions based on what type of stock you're investing in. Let's dive into each of the 6 categories. 1. Slow growers. These are the companies that are already big and established, but their growth is steady and slow. Think of them as reliable, but not super exciting. They're not going to deliver huge returns, but they're usually stable and pay good dividends. If you're looking for a low-risk, steady investment, slow growers might be right for you. The strategy here is to hold them for the long term and collect the dividends while enjoying steady, if not spectacular, growth. Number 2, stalwarts. These are the solid, dependable companies that are growing at a moderate rate, usually around 10 to 12% per year. They're often large companies with a strong market position, and they tend to be less volatile than smaller companies. Stalwarts might not be as flashy as some high-growth stocks, but they're reliable and provide steady returns. The strategy with stalwarts is to invest for moderate growth and steady income over time. Number 3, fast growers. Fast growers are the exciting ones. These are smaller companies with the potential for explosive growth. They're often in emerging industries or sectors that are just starting to take off. Investing in these companies can come with a lot of risk, but the potential for high returns is huge. The strategy here is to do your research, pick companies that have the potential to grow rapidly, and ride that growth wave. Number 4, cyclicals. Cyclical stocks follow the ups and downs of the economy. When the economy is doing well, these stocks soar. But when the economy hits a downturn, they can drop just as fast. Examples include companies in industries like cars, housing, or travel. The The strategy with cyclicals is to buy them when they're out of favor during economic slumps and sell them when the economy is booming. 5. Turnarounds. Turnaround stocks are companies that are struggling but have the potential to bounce back. They may be going through a rough patch or facing some major challenges, but with the right leadership, strategy, or changes, they can turn things around and start growing again. These are riskier investments, but if you pick the right one at the right time, it can pay off big. The strategy with turnarounds is to identify companies that are in trouble but have strong potential for recovery. 6. Asset plays. Asset plays are companies that are undervalued based on their assets, such as land, buildings, or patents, that haven't yet been fully recognized by the market. These companies might not be growing rapidly, but their assets could be worth a lot more than the stock price suggests. The strategy with asset plays is to buy these stocks when they're trading below their true value and wait for the market to catch up. Each of these categories requires a different approach, so it's important to understand what type of stock you're dealing with and tailor your investment strategy accordingly. So, whether you're looking for steady income, explosive growth, or a great deal on undervalued assets, knowing which category a stock falls into will help you make better decisions. By understanding the differences between slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays, you'll be in a much better position to build a portfolio that fits your financial goals and risk tolerance. In Chapter 16, Designing a Portfolio, Peter Lynch shares practical advice on how to build a well-balanced and diversified portfolio that suits your personal risk tolerance and investment goals. The key takeaway here is that every investor should craft a portfolio that fits their unique needs. So let's break it down. First off, Lynch stresses that diversification is important, but it's not about having hundreds of stocks just for the sake of it. You want to spread your investments across different sectors and types of stocks, but make sure you understand each one. The idea is to have a mix of investments that won't all be affected by the same risks. For example, owning a mix of growth stocks, value stocks, and cyclicals can help balance out your portfolio's risk. This way, when one sector underperforms, the others might pick up the slack. Next, Lynch emphasizes that risk tolerance is something personal. What might feel like a reasonable risk for one investor could feel like too much for another. For instance, some investors might feel comfortable with more volatile, fast-growing stocks, while others might prefer the stability of slow growers or stalwarts. It's important to assess how much risk you're willing to take before designing your portfolio. If you're younger and have more time for your investments to grow, you might take on a bit more risk. But if you're closer to retirement, you'll probably want a more conservative approach. Lynch also talks about the importance of understanding what you own. This is a big one. You should never invest in a company or stock just because it's trending or because someone else told you it's a good idea. Take the time to research each stock in your portfolio. Understand the company's business, its financials, and its growth potential. When you truly understand what you own, you'll be in a much better position to make smart decisions, especially during market volatility. Additionally, Lynch suggests that you should regularly review your portfolio to make sure it's still in line with your investment goals. Over time, some stocks will outperform while others might fall behind. And your portfolio should reflect your current financial situation and goals. Rebalancing is key to keeping things on track. Finally, Lynch advises against constantly buying and selling based on short-term market movements. Instead, focus on the long-term view. Don't panic when the market goes down or get overly excited when it goes up. Invest in companies you believe in and hold them for the long haul. To sum it up, building a portfolio isn't about picking a bunch of random stocks. It's about diversifying wisely, understanding each investment, and tailoring your portfolio to your personal risk tolerance and financial goals. By doing so, you'll be setting yourself up for long-term success in the stock market. In Chapter 17, The Best Time to Buy and Sell, Peter Lynch gives us his advice on when to make investment decisions, and it's not about trying to time the market. Instead, Lynch focuses on making moves based on company-specific factors, rather than reacting to market conditions. Let's break it down and understand when it's really the right time to buy and sell stocks. First, Lynch makes it clear that timing the market, trying to predict when the market will go up or down, is nearly impossible. If you try to buy and sell based on short-term market movements, you're likely to make emotional decisions that can hurt your long-term returns. Instead, Lynch encourages investors to focus on company fundamentals, the health and growth prospects of the companies they're investing in. So, when is the right time to buy? According to Lynch, buy when the company is performing well and is undervalued. For example, if a company is growing steadily, making smart moves in the market, and its stock is trading at a price that's lower than its actual value, that could be a great time to buy. Don't get caught up in buying just because the market is booming or because everyone else is jumping on a trend. Instead, do your research, understand the company, and make sure the stock is undervalued based on its real potential. On the flip side, when should you sell? Lynch believes you should sell when a company's fundamentals have changed for the worse, not just because the stock price has gone up. If the company starts making poor decisions, losing market share, or showing signs of long-term decline, then it might be time to sell. But if the company is still doing well and you believe it has more growth potential, there's no need to sell just because the stock price has risen or market conditions are shifting. Lynch also reminds us that quality stocks should be held long-term. If you've done your homework and picked strong companies, you should be able to hold them through market ups and downs without feeling the need to constantly buy and sell. The real money is made by sticking with good companies over time and letting the stock grow along with the company's success. In short, the best time to buy and sell isn't dictated by the overall market, but by the company's performance and potential. Buy when a company is solid, undervalued, and poised for growth. Sell when the company's fundamentals have deteriorated. And remember, hold onto your quality stocks for the long haul. By focusing on the company itself rather than market fluctuations, you'll be in a much better position to make smarter, long-term investments. In Chapter 18, the 12 silliest and most dangerous things people say about stock prices, Peter Lynch takes on the most common misconceptions and myths about the stock market. These are the phrases you've probably heard a million times, but as Lynch explains, they can mislead investors and cause them to make irrational decisions. Let's break down some of the most dangerous stock market sayings and why they're not true. 1. This stock is cheap. Just because a stock has a low price doesn't mean it's a good deal. Lynch explains that the value of a company should be based on its fundamentals, its earnings, growth potential, and financial health, not just the price tag. A stock could be cheap for a reason, like poor performance or a bad business model. So, don't fall for the cheap stock trap. 2. This stock has a great story. Stories are nice, but they don't pay the bills. Just because a company has a great narrative or vision doesn't mean it's a solid investment. Lynch warns against getting caught up in hype and forgetting to look at the numbers, like earnings and growth. A good story alone doesn't guarantee success. 3. The stock is going up, so it must be a good buy. Just because a stock price is rising doesn't mean it's a great investment. In fact, buying into a stock just because it's going up is often a bad move. Stock prices can be driven by short-term market sentiment, not long-term value. Make sure you're buying for the right reasons, not just momentum. 4. It's a good stock because it has a lot of potential. Potential is great, but potential alone doesn't pay dividends. Many stocks may have great future potential, but that doesn't guarantee they'll succeed. It's important to research and understand how the company plans to achieve its potential, and if it has the resources to do so. 5. This stock is a safe bet because it's been around for a long time. Just because a company has been in business for decades doesn't mean it's a safe investment. Lynch emphasizes that the businesses have to keep evolving to stay competitive. A company may have been successful in the past, but without growth and innovation, it could be in trouble. 6. You should only buy stocks in popular industries. Just because an industry is hot right now doesn't mean it's the best place to invest. Often, the best opportunities are in boring industries or sectors that others overlook. Lynch advises looking for companies that are undervalued and underappreciated, even if they're not the trendiest. 7. It's a great buy because the CEO is great. A good CEO can certainly make a difference, but it's not the only factor in determining a stock's value. Lynch reminds us that the company's fundamentals, like earnings, growth potential, and market position, are much more important than the CEO's personality or leadership style. Narrate. The stock is a great buy because it's been through a tough time and is bound to bounce back. Just because a stock has gone down doesn't mean it's a good time to buy. It might be down for a reason: poor management, declining demand, or competition. Always understand why the stock is struggling before deciding to invest. 9. Buy stocks for the long term and forget about them. While holding stocks for the long term is a good strategy, it's not a set and forget approach. You still need to monitor your investments, review the company's performance, and stay informed about any changes that could affect the stock's value. 10. The stock is going to keep going up because it's a hot trend. Trends come and go, but stocks should be valued based on their long-term fundamentals, not short-term hype. Just because a stock is in a trendy industry doesn't guarantee success. Stay grounded in the company's true potential. 11. You should buy stocks when the market is doing well. The market may be up, but that doesn't necessarily mean it's the right time to invest. Stocks can still be overpriced in a rising market, and you might not get the best deal. Instead, focus on the company's fundamentals and buy when you see value, regardless of what the market is doing. 12. The market is too risky, so I'll just stay out. Lynch argues that while there is risk involved in investing, the bigger risk is not investing at all. Over time, the stock market has historically outperformed other types of investments, like bonds or savings accounts. Avoiding the market altogether can mean missing out on long-term growth. The overall message in this chapter is clear: don't fall for cliches. Always rely on sound research, understand the company's fundamentals, and ignore the market noise. By avoiding these common misconceptions and focusing on what really matters, like earnings, growth, and company health, you'll be in a much better position to make smart investment decisions. In Chapter 19, Options, Futures, and Shorts, Peter Lynch warns everyday investors about the risks of complex financial instruments like options, futures, and short selling. These tools can seem tempting, but Lynch strongly advises against them for most individual investors. Instead, he recommends sticking to simple, straightforward stock investments. Let's dive into why these complicated tools might not be the best choice for you. First, let's break down what these terms mean. Options. These are contracts that give you the right to buy or sell a stock at a specific price within a certain time frame. They can be a powerful tool for experienced traders, but they're risky and can lead to big losses if you don't fully understand how they work. Futures. Similar to options, futures contracts involve agreeing to buy or sell an asset at a future date. But unlike options, they obligate you to complete the transaction. Futures are often used for commodities like oil or wheat, but they can be volatile and complicated. Short selling. This is when you borrow shares of a stock and sell them, hoping the price will fall so you can buy them back cheaper and return them. It's risky because if the stock price goes up instead, you can lose a lot of money. So why does Lynch caution against these strategies? He argues that for the average investor, these tools are often more trouble than they're worth. Here's why. 1. High risk. These instruments are highly speculative, meaning you're betting on the future direction of a stock or market, which is unpredictable. One wrong move, and you could lose a significant amount of money. Even experienced investors can get caught in these risky situations, but for beginners or those who don't have time to watch the market constantly, they're especially dangerous. 2. Complexity. To use options, futures, or short selling effectively, you need a deep understanding of the market and a lot of research and experience. For the average investor who doesn't have the time or expertise, these strategies are just too complicated. Lynch believes in investing in what you know. Investing in companies whose businesses you understand, not in financial instruments that require constant monitoring and knowledge of how the markets work. 3. Focus on long-term value. Lynch encourages investors to stick to straightforward stock investments. If you buy stocks of companies you believe in based on solid research and their long-term potential, you're more likely to see consistent returns. This is a simpler, safer strategy that doesn't involve playing the market or taking on high risks with complex instruments. 4. Emotional stress. When you trade options or futures, the stakes are high, and it can be emotionally exhausting. You're constantly worried about the timing, the fluctuations, and your potential losses. For most investors, it's better to invest in stocks that you can hold long-term without having to worry about short-term market fluctuations. Lynch's message is clear. Keep it simple. Stick to investing in companies with solid earnings, strong growth potential, and a business model you understand. Don't get distracted by complicated instruments like options or futures that can add unnecessary risk and stress to your investments. By focusing on straightforward stock investing and understanding the fundamentals of the companies you're investing in, you'll have a much better chance of long-term success. So, if you're a beginner or looking for a less stressful investment strategy, skip the complex tools and stick with what's simple and proven. In Chapter 20, 50,000 Frenchmen Can Be Wrong, Peter Lynch gives us one of his most important lessons. Don't follow the crowd. Just because everyone else is investing in a stock or a trend doesn't mean it's the right move for you. Lynch explains that popular opinion can often lead to bad investment decisions, and he encourages investors to do their own research and make decisions based on individual analysis, rather than just jumping on the latest bandwagon. Let's break it down. Lynch starts by saying that there's a common saying, 50,000 Frenchmen can't be wrong, which implies that if a lot of people are doing something, it must be right. But Lynch quickly shoots that idea down. Just because something is popular doesn't make it a good investment. In fact, following the crowd can often lead you to make impulsive emotional decisions that don't align with your own investment goals. So, what should you do instead? Lynch stresses the importance of independent thinking. He encourages you to research companies on your own, look at their financial health, their growth potential, and what you truly believe about their future. If you're just following what everyone else is doing, you're likely to end up in situations where you're investing in overhyped stocks or sectors that are actually overvalued and about to face trouble. Lynch also explains that when people get excited about a popular stock, they often ignore warning signs. Popular stocks can become overpriced, and investors might end up buying high, only to lose money when the stock inevitably drops. By doing your own homework and sticking to your own analysis, you can avoid these pitfalls and make smarter decisions that are based on the actual value of a company, not just the latest trend. Lynch reminds us that great opportunities often come from stocks that no one is talking about, the underdogs that might be overlooked by the crowd. If you spend the time to do your own research, you might just find some hidden gems that have huge potential. So, what's the takeaway from this chapter? Don't be swayed by what everyone else is doing. Think independently, do your research, and trust your analysis. Following the crowd might make you feel safe, but in the world of investing, it's often the crowd that's wrong. By sticking to your own strategy and focusing on the fundamentals, you'll be in a much better position to make decisions that align with your financial goals and lead to long-term success. In the epilogue, Caught with My Pants Up, Peter Lynch wraps up his book with a personal story that perfectly sums up his investment philosophy. This anecdote highlights the importance of staying fully invested, being prepared, and constantly doing research. Lynch uses this experience to reinforce the core ideas he shared throughout the book, and it offers a perfect reminder of why a long-term approach to investing is so powerful. So, let's dive into the story. Lynch recalls a time when he made a mistake that taught him a valuable lesson about being prepared. He was managing a big portfolio and at one point found himself underestimating the importance of staying fully invested. At that time, he made the mistake of holding too much cash, thinking he was being cautious. But as we know, sitting on cash means missing out on opportunities, especially when the stock market is on the rise. He shares how he felt caught off guard, like someone who's caught with their pants up when the market unexpectedly soared and he wasn't fully positioned to take advantage of it. This experience taught him a crucial lesson. Being fully invested in quality stocks is key to reaping the rewards of the market's growth. Trying to predict market dips or hold out for a perfect time can lead to missed opportunities. Lynch emphasizes that quality investments, backed by thorough research and a long-term commitment, are what will truly pay off. He reminds us that the market has ups and downs, but if you're focused on strong companies with solid fundamentals, you'll weather those fluctuations and come out ahead. It's all about staying invested in the right stocks, being patient, and not letting short-term fear or uncertainty stop you from sticking to your plan. So what's the final takeaway from this chapter? Lynch wants you to know that the key to successful investing is staying committed to your strategy, doing your research, and not being scared to stay invested, even when the market looks uncertain. As he says, there's no need to try to time the market perfectly. Instead, focus on buying great companies, holding them for the long term, and letting the market's growth do the work for you. By sticking to these principles, you'll be on the path to making smart, profitable decisions in the stock market. And that's a wrap on One Up on Wall Street. I hope you found these insights as valuable as I did. If you enjoyed the video, make sure to like, share, and subscribe for more book breakdowns and investment tips. Drop a comment below with your thoughts or any questions you have, and I'll catch you in the next one. Happy investing.